So hi everyone, welcome back. In this new lecture we are going to discuss about a new concept, that is bond immunization. Immunization, the word itself means protection. So how we are going to discuss this? Let's start with a simple history of one of the question that we discussed in the last lecture. Let me just scroll down to this question. Question number 83. Remember this thing? This was a question where Mr. A needed 1 lakh rupees after 2 years, and he wanted to know how much he should invest today. Understand? How much he should invest today so that he will get 1 lakh rupees in both the bonds, from both the bonds after 2 years, irrespective of irrespective of the maturity of the bonds. Okay, so what he did in that situation was he invested present value of 1 lakh rupees. So we first discounted 1 lakh rupees at 10% YTM by 2 years, and then we arrived at one of the figure called as 82,600, 1 lakh into 0.826, and then that 82,600 was bifurcated into bond X and bond Y in such a manner that bifurcation was dependent, that 61% and 39% of the weight was dependent on the concept that the portfolio duration should be equal to 2. And why the portfolio duration should be equal to 2? Because we wanted money after 2 years. So practically speaking, I can say that this requirement of needing the money after 2 years is called as investor's horizon. Right? Now what we did exactly was, I will just write down few things here. The very first thing we did is we equated investor's horizon with the portfolio duration, or we can say investment duration. So it can be a single bond, it can be a combination of lots of bonds. Investment duration. Practically speaking, if you are able to equate the duration of the entire portfolio that with your investment horizon, so duration means, first of all, the time, weighted average time required to return present value of cash flow. So 82,600 that you invested will become 1 lakh at 10% after 2 years. So that 2 duration also means that time required to return the present value of cash flows. Now understand why we are equating these two things, investor's horizon and investment duration, because our horizon means the time in which we need our money back. So 2 years is given in the question in which we need our 1 lakh rupees back, and the duration also means the same. 2 is nothing but the time required to return the present value of cash flows, that is 82,600. So when the amount will be returned, it will not be 82,600. 82,600 is the present value of future cash flows, or we can say present value of 1 lakh rupees. So 1 lakh rupees will be given at the end of 2 years by the other party to us when we will sell the bond or when we will mature the bond. So it has the same meaning. That's why investor's horizon should be equal to the investment duration. If we do that, if we successfully able to do that, we are able to do that, then we will receive exactly the amount that we required in a period that we want. And for that purpose, the only thing that you need to do is make sure that the duration of your investment is equal to the year that you wanted, the horizon. Okay, this is one thing, but there are certain practical problems that happen over a period. Once you start your investment, starting the investment is okay, You just created a portfolio. In this question also we created a portfolio where the weighted average duration was 2, and we said that buy 52 bonds today, buy 34 bonds today, and then move on. But tell me one thing, there will be some practical problems that will happen. First thing is this, the major change that will happen is this current yield, this current yield 10%. The current yield 10% is the rate which is at present. After 6 months or after a year, this yield might change, and the moment the yield will change, the amount that you are going to receive after 2 years will also change. How? Let me tell you one thing. For that purpose, what I'm going to do, I'm just going to open the theory book, and on the theory book, question number 71, page number 71, question number 22 in security valuation, there is one example that we have given. A portfolio is immunized when, understand, a portfolio is said to be immunized when its duration equals the investor time horizon. When the duration of the portfolio equals the time horizon, and we have explained it with an example. So let me first read the example. 15.30% is your coupon rate, 1000 rupees of the face value, 7 years to maturity, and current YTM is 10%. Okay. There are two examples that I have taken. One when the YTM is increasing to 11%, and another with the YTM decreasing to 9%. So I am taking the second example because the first one has some portion on the second page, so I will have to shuffle it again and again from that page to this page. I can explain everything from here as well. Okay, let's continue. Okay, so understand, I will just explain couple of things in this. See, in the first row, time is given 1, 2, 3, 4, 5, 6, 7, 0, 1, 2, 3, 4, 5, 6, 7. This is nothing but the years till maturity. And in the second row, maturity is given, means how many years are left for the maturity. At 0.7 years are left at the end of first year, only 6 years are left. At the end of 2 years, only 5 years are left, and so on. Okay, so by every passing year, the maturity is getting reduced by 1 year. Okay, then the coupon amount that you will receive, 153 every year, 15.30% on 1000. And the principal that you will receive at the end of 7th year is this much. Now, if we take YTM at 10%, if we take YTM of 10%, this is the 10% YTM every year. Now, what will happen? If you will calculate the duration of the bond at 0 point, it will come to 5. After 1 year, it will come to 4.5. After 2 years, it will come to 3.94. So we have calculated the duration according to the need. Now, bond price. Please understand what is this. At 0 point, if you calculate the present value of future cash flows, means present value of all these cash flows, the present value will come down to 1258.03, discounted at 10%. Okay. So practically speaking, today if you want to buy the bond, it will cost you around 1258.03. Now, moving ahead from the 0th point, let's say for example, you want to sell the bond at the end of first year. How much money you will receive? When you will sell the bond at the end of first year, the very first thing that you will receive is the first year's interest. That will be in your pocket. This is the amount 153. And you will sell the bond at the first year's ending price, that is 1230.83. You will sell the bond at this price and pocket 153 rupees for keeping the bond for 1 year. So the total cash flow that you will have after selling the bond is 1383.83. Now this 1230.83 is calculated by taking the present value of future cash flows. Now the future cash flows for this is the bonds from second year, interest from second year, and the maturity of 6 years only, because 6 years are only left, and then bringing the present value by 10% discount rate, that will go to 1230.83. Okay, this way you calculated the market price, assuming that it is trading in the market at fair price. You sold the bond at 1230, so you received 1230.83. You also received 153 of the previous year. The total cash flow is 1383.83. 83 if you want to sell the bond at the end of first year. In a similar manner, we have calculated the cash flows that we will receive if we sell the bond at the end of each year. Now let's just take second year. If you want to sell the bond at the end of second year, it will be the present value of the future cash flows, and the future for this will start from third year onwards. Am I right? Third year onwards. So I will sell the bond at 1200 rupees plus, understand, I invested at 0 point, I received 153 at the end of first year, but I'm not selling the bond here. So what I'm going to do, I will just reinvest this 153 rupees for another 1 year at 10%. At 10%. So it will come to 168.3. Understand? It will come to 168.3. So at the end of second year, you have the interest of the first year, interest on that interest for one more year. So 153 plus interest of 15 rupees 30 paisa and the second year interest. Three things: 153, 153 and the interest on this 153. Getting it? So the total comes to 153 plus 168, that's 321.3. At the end of second year, you will have 2 years interest and interest on interest for the first year. So the total cash flow after selling the bond at the end of 2 years will be 1522.21. Right? Again, I will just show you. This 321 includes this 153, this 153 and interest on the first 153. Okay. So if we sell the bond at the end of second year, we will receive 1522.21. In similar manner, if we sell the bond at any particular time, we will receive this much of the amount. Okay, understood the table? Now, imagine from after purchasing the bond at 1258, imagine that the bond's yield falls to 9% for all the future years. The moment you purchase 1250 at 1258, the yield has gone down. If the YTM is decreasing, the market price will be higher. So if you want to sell the bond at the end of second year, instead of 1200 rupees, now you will receive 1245. Why you will receive 1245? Because the YTM has gone down, and when you calculate the present value of future cash flows, it will come up to 1245. So instead of getting 1200 rupees, you will be benefited with increase in the market price by 45 rupees, almost 45 rupees. You can clearly see it here. One figure is this and the one is this. Why you are receiving more on selling the bond? Because the YTM has gone down. This is called as the price risk. What do you mean by the price risk? Price risk is the amount of principal, or when the bond will be sold in the market, you might lose or gain. You might lose or gain because of increase and decrease in the market price of the bond, because the YTM has increased or decreased. This is a price risk. Okay, this is a price risk. Okay, in this case, we took YTM to go down by 1%. What if the YTM has gone up by 1%? At that time, we would have received less than 1200 rupees. Do you agree? At that time, we would have received less than 1200. I will just show you here. If you will see, if the YTM increases to 11% at the end of second year, the market price will be 1152, this figure, 1158.92. So instead of receiving 1200 rupees, it will be a loss to us for around 41 rupees, 42 rupees. So that is not fair, right? This is called as price risk. The risk can result into profit as well as loss. Okay, let's come back to the example where we reduce the YTM by 1%. Obviously, we saw that the bonds price is being increased and we are being benefited by the change in the YTM, decrease specifically. But there is one loss due to this change, that is the loss in the reinvestment of coupon. Since YTM has decreased to 9%, now you can reinvest 153 rupees not at 10% but only at 9%. So you will be receiving less interest this time. Understand? At 10%, the reinvested amount of the interest was 321, and in this case it is 319.77. Although small, but there is a loss. Why loss? Because the YTM has gone down. This is called as reinvestment risk. This is called as reinvestment risk. When you receive a lesser amount of coupon, when you get lesser interest on interest because of the fall in yield. I told you all these things with respect to the fall in YTM in order to conclude two things. When the YTM changes, there can be price risk and there can be reinvestment risk. And both of them may result into losses. I will tell you one more point. Just take this 6th year. Just take this 6th year. You will understand, if you would have sold the bond in the 6th year, you would have received 1048.18 and reinvested amount of interest of 1180.49. The total that you would have received was 2228.67. But in case the bond YTM would have gone down by 9%, by 1% from 10 to 9 from the very first year, and in that case, if you would have sold the bond in 6th year, you would have received only 2208 rupees. There is a loss in this case. Although you are receiving more in market price, instead of 1048 you are getting 1057, but the loss is higher in case of reinvestment. Instead of getting 1180, you are only receiving 1151 rupees of the reinvestment coupon, because all the interest that you have invested in the last 4 or 5 years, 153 rupees, you received only 9% on that instead of 10%. Okay, so the net loss is 19 rupees. You can clearly see that what is the profit or loss due to change in YTM. From receiving 1383 to 1435, there is a profit of 51 rupees. If you sell the bond in the 4th year, instead of 1841, if the YTM changes, you will receive 1859. There is a profit of 17 rupees. So till this point, there is a profit if the YTM goes down. But from this point, there is a loss if the YTM goes down. So there is always a risk that you may not receive your desired amount when you need it. All in all, what I want to say from this entire example is just a simple thing. A change in the YTM may affect your targets, may affect your goals. You might have invested in the bond at the beginning with certain goal of selling the bond or needing some money after 5 years, let's say for example for a wedding, for a foreign trip or anything. So you need a fixed amount, let's say 2 lakh rupees. And that should not change because of the change in the YTM. You can clearly see that you can clearly see that the total amount that you are receiving is being changed. You may receive more, but you may receive less as also, no? So in order to protect the cash flows that we will be receiving from the bond, you can clearly see there is one point in the entire scenario when the YTM was 10% and when the YTM was 9%, there is one point where there is no profit, no loss. That is 5th year. See, in the 5th year, if you sell the bond, you will receive the total cash flows of 2026. In the 5th year, if you sell the bond when the market price, when the YTM is 10% and 9%, the cash flows will be same. So even if the YTM is going down, you are receiving the same amount, 2026.48. Even if the YTM is going up, you are receiving the same amount at the end of 5 years. So what is the magic in that 5 years? 5 years is nothing but the duration which was there at the beginning. Now what we should conclude? It means that whenever we are investing in a bond with a certain goal of needing certain amount of money after a certain period, so the period is certain, money is certain, the goal is certain, And we do not want any uncertainty in the entire goal. If we do not want any uncertainty, there should not be any loss in our situation, any profit or loss in our situation. And that can happen only when in such scenario the duration equals your horizon. So if you need money after 5 years, your bonds duration should be 5. Why 5? Because this is the point where changes in YTM will not affect your cash flows and you will receive the money as you desired 5 years back. At all point of time, you need to understand that the duration of the portfolio should match with your horizon. That's why I told you the duration of the portfolio should match with your horizon, because that is the point where there is no profit or no loss. That is called as bond immunization. What do you mean by immunization? Immunization means the protection from suffering losses or from bearing losses. And how do we protect? It's very simple. Investors' time horizon should be equal to the duration. That's it. You can clearly see with this example that this is the only time, the duration is the only time when your profit or loss is 0. Okay, one more thing. Even if the YTM is changing, and this is more practical, that the YTM is for sure going to change in the coming time. Every year assuming the YTM will be 10% is not practical. It will keep on changing. The moment YTM changes, you will have to readjust the duration. You will have to make sure that the duration is equal to the investor's horizon every time the YTM is changing. Okay, understood the concept of bond immunization. Let me just finish it by summarizing all the things. Duration is the time where change in YTM does not affect the net cash flows received by closing the bond position. Hence, if investors' horizon is equal to duration of portfolio, then there will not be any losses or profit change in resulting cash flow. This will help in achieving our goal set at the beginning. The goal that we set at the beginning, that we want 2 lakh rupees at the 1 lakh rupees at the end of 2 years, that might get affected if the YTM changes. But if we make sure that our horizon of 2 years is equal to the bond's duration, then there will not be any losses that we will have to suffer because of the change in YTM. That is what you need to understand. So there are few things that we should read. First of all, see, 5 years is the duration of the bond at time 0. At 5 years, whether Y means the yield goes up or down, our portfolio value suffers only a minor change. That is because of the rounding off. Okay. See, at time 0, if we set the duration equal to the target date, the date where we need money, okay, and if we set the bond's future value at the target date equal to the amount of the obligation, very simple, they are saying that if we need let's say for example 2026 rupees at the end of 5 years. There are two things that we need to set. If we need money at the end of 5 years, the duration should be 5 years, and also we should be receiving so much of the amount at the end of 5 years that we want. So basically, if we want to pay someone 2 lakh rupee, or let's say for example 2026 rupees, so that 2026 of the liability, that is the liability if you want to pay someone. So that 2026 of the liability should be equal to the asset. That means we should be receiving the same amount from somewhere. So this asset 2026.06 will be received by you by selling the bond at the end of 5 years. Now that asset should be created by investing the present value of the same. So 2026.06 present value will be 1258.083. In such a manner you can create. So present value of asset should be equal to the liability. In another word, I can just write down like this. Let's say for example, after 5 years, you wanted to pay someone 2026 point something, 2026. And for that purpose, what you will have to do, this is called as liability. For that purpose, you will have to create an asset of 2026. Asset in such a manner that you will receive 2026 at that point. And in order to do that, you will have to invest the present value. What you have to do is invest the present value of that asset. So the moment you will receive invest like 12, how much the amount is, the moment you will invest 1258, it will become 2026 at the end of 5 years, and you will receive this and you can settle your liability. So this is the purpose. So at the end, at the beginning, what you have to do is first you will have to invest the present value of your liabilities. Present value of the liability you will have to invest. Whatever you want at the end of 5 years, calculate the present value of that, invest that, and make sure that the duration of this is 5 years. So these are the two things that you need to take care of. In the previous question also, understand the question that we discussed in the last lecture, we did the same thing. First of all, we set the duration to 2 years. That's when we calculated 61% and 39%, right? And also we invested the present value of the liability. So we needed 1 lakh rupees after 2 years. The present value of that was 82,600. So that this is mostly a question of bond immunization. That's my mistake that I have covered it up here. But in the next edition, I will shift this question to the bond immunization. Okay, understood this? Let's go back to the main topic. So that's what the question is saying. And if we set the bond's future value at the target date equals to the amount of obligation, okay, then we are not greatly affected by changes in Y. In general, as long as the target date is equal to the duration and current value of asset is equal to the current value of liabilities, we are said to be immunized. So the only things that you need to remember in the bond immunization is, first, your target period means investor's horizon should be equal to the duration of the portfolio. Present value of the asset should be equal to the present value of liabilities. That means if you want 2 lakh rupees at the end of 2 year, 5 year, calculate the present value of that and invest that. So present value of asset should be equal to present value of liability, and the bonds portfolio duration is calculated by this method, which is nothing but the weighted average. Weight multiplied by duration and then summation, that we discussed in the previous lecture itself. Okay, so this is what the bonds duration is. Bonds duration is nothing but making sure that you are not suffering any losses. So have a look on the question now. Question number 90, have a look. You will get more clarity when you will solve some questions. The following data are available for 3 bonds ABC. These bonds are used by a bond portfolio manager to fund an outflow scheduled in 6 years. Please understand, this is your target horizon. You have an outflow scheduled in 6 years. That means you know that after 6 years you will need certain amount of money because you have to pay to someone else. So that is the liability. You need to create the asset for that. So whatever is the liability, calculate the present value of it and invest it in the market. And your target duration or duration of the portfolio should be 6 years. Current yield is 9%. All the bonds have a face value of 100 each and will be redeemed at par. Interest is payable annually. So there are 3 bonds. The maturity of all the 3 bonds are 10, 8, 5. 10 years, 8 years, 5 years. Okay. Coupon rate 10%, 11%, 9%. Now understand one thing. You might say that, sir, this third bond is not applicable to us because it is getting matured at the end of 5 years and we need money at the end of 6 years. But please understand, it is not the duration or the horizon does not depend on the maturity. What we can do is we can reinvest at the end of 5 years. We can reinvest the money in bond C and sell it after 1 more year in the market. Although 4 more years will be left for the maturity, but we don't have to wait for the maturity. We can sell it in the market. Okay, so that's why the duration should be equal to the times horizon targets. Now, what we have to do is first let's calculate the duration of the bond. Duration of the bond is very simple. There are 3 different methods which you can use. Summation of present value into year divided by summation of present value. Second, summation of weight into year. Third, 1 plus YTM formula, or we can say shortcut formula. We have all the things that we need. First, we have coupon rate, we have face values, maturity and yield also. So if you will do it, you will get the duration. I am not doing these calculations as we have done it a lot of time. So bond A, this much of the calculation that you will have to do. My suggestion to you is go with the formula. You will get the answer quickly. So the duration of the bond in this case is 6.86 years. Okay, first duration. Second duration of the bond is 5.84 year and the duration of the bond in C is 4.24 year. So let's say we have arrived at these. Our first target should be the portfolio duration should be equal to 6. Second is the amount. So let's say first in this case, have a look. Amount of investment required in bond B and C. Acha, let's read the second part. We are done with the calculation of the duration of each bond. Now have a look on the second part. The bond portfolio manager has been asked to keep 45% of the portfolio money in bond A. Whatever the investment is, invest 45% of that in bond A and calculate the percentage amount to be invested in B and C that need to be purchased to immunize the portfolio. This word matters the most. In order to immunize the portfolio, the very first thing is you need to make sure that the bond's duration is equal to your target's horizon. So the duration should be equal to 6 years. Duration of your portfolio. Have a look. What is the question's number? 90, right? So portfolio duration is equal to summation of weight into duration of individual bonds. We need, first of all, it should be equal to investors horizon, which is 6 years, and the formula for duration is weight into DI, WIDI. Okay, and this is nothing but weight of A bond, duration of A bond, plus weight of B bond, duration of B bond, plus weight of C bond, duration of C bond should be equal to C. Okay, great. Let's keep the weights. It is very clear from the question that 45% of the total should be invested in A. The duration of all the 3 bonds have been calculated in the very first part, 6.86 for A, plus let's keep the weight of B bond as weight of B only, and duration of B is 5.84, plus let's make weight of C as 1 minus weight of B. Do you agree with this? See, the only 2 things that we have to find out is weight of B, weight of C, weight of A. Or instead of that, we will write it in this manner. Weight of A is fixed as 0.45. Let's keep weight of B as weight of B. and the total should be 1. Can you calculate weight of C? Yes sir. Weight of C is nothing but 1 minus 0.45 minus weight of B. Am I right? 1 minus 0.45 minus weight of B, or in another word I will just write it down. Weight of A plus weight of B plus weight of C should be equal to 1. So this is 0.45 plus weight of B plus weight of C is equal to 1. So weight of C is equal to 1 minus 0.45 minus weight of B. Do you agree with this? So let me write it down. 1 minus 0.45 minus weight of B into the duration. What is the duration of C? 4.24. And this should all be equal to 6. If you will solve this entire part, you will get weight of B. I will just start from this point. 3.087 plus 5.84 weight of B plus 4.24 minus 1.908 minus 4.24 weight of B is equal to 6. Let's solve this. 3.087 minus 3.087 minus 1.908 plus 4.24 minus 6. The answer will be 0.581 on this side. 5.84 minus 4.24. 1.6 weight of and weight of B will be 36.31%. So this is 45, this is 36.31%, and the balance will be weight of C. How much? 18.69%. So these are the three weights. Let me just check with this. See, if you will solve the equation, it will come to 36.21% and 18.79%. 31, there might be some rounding of differences. So this is the thing. You can just simply put weighted average, weight of A, duration of A, and so on. And if we invest in this manner, the entire amount that we have, if we invest in every bond, our bond will be immunized, because these weights will make sure that the duration of the portfolio is equal to 6, and that is when we need the money. So when we will be recovering the money, the amount given by the portfolio will be exactly equal to what we need today. So that is how we have to calculate. Okay. Are you done with the calculation of weights? How much? Calculate the percentage of amount that to be invested in B and C. It was very simple. What you had to do is summation of weight I DI is equal to 6, and then solve it. You will get the percentage for B and C. After the portfolio has been formulated with these percentages, an interest rate change occurs. That means the YTM is now changing, increasing the yield to 11%. So 1% YTM has gone up. That might result into the affection of that might resulted into the duration getting affected. Okay, yield to 11%. The new duration of the bond is A, B, and C. The new duration of these bonds are given to you. Is the portfolio still immunized? See, if portfolio will still be immunized only if the duration of the bond is 6 years today. After 1 year, it will be 5 years. The required duration will be 5 years. But they are all talking about today's situation. So let's find out if the duration is still 6 years. On the third part, portfolio duration, weight of A DA plus weight of B DB plus weight of C DC. This is how you have to calculate. Duration is nothing but the weighted average of the individual bonds duration. Okay, 45% in this multiplied by duration of A. It has changed to 7.15 year because of the change in YTM, plus 0.3621 into duration of B 6.03 plus 0.1879 weight of C into duration of C 4.27. Now calculate. It comes to 6.20. Do you think the bond is still immunized? No, sir. The bond is not immunized anymore because the duration is not coming to the desired one. See, the duration is coming to 6.20 year. No, portfolio is not immunized. As the duration of the portfolio has increased, that means we will get our money in 6.20 years that we want instead of 6 years. So this will be a problem for us at the end of 6 years. So what should be done? How to correct that? It's very simple. Calculate the new weights. You will have to shuffle from bond B to C, because bond A is very clear that the total investment should be 45% in that. See, determine the new percentage of B and C that are needed to immunize the portfolio, bond A remaining at 45%. You just have to calculate. You just have to calculate the new weights. So what you are going to do is very simple. Keep this here and it should be equal to 6. Okay, and make sure that the new duration are being used. Also make sure that you are keeping weight of A as 45%. The only thing which will be unknown is weight of B and weight of C, where you can keep it as weight of B and 1 minus 0.45 minus weight of B. Solve the entire equation. You will get new percentages for weight of B and weight of C. And so what will happen? Just let's see. The new percentages for weight of B and C is 30.34 and this is for B and C comes to respectively according to the percentage of investment of B and C is 24.66 or 25 and 30.34. Acha, okay. 30.34 and 30%. Now what you have to do is very simple. Let's say I will just write it down. A, B, C. When the YTM was 10%, I think. How much? 9%. When the YTM was 9%, you had invested in the portfolio in this manner, right? Now YTM is 11% and in order to keep the bond immunized, the weight should be 45% or 24.66% and 30.34%. What does that mean? That means buy or sell. You will have to reduce your investment in bond B from 36.21 to 24.66. Sell bond B worth 11.55% and invest the same in C. That's what you have to do to rebalance your portfolio. What you are doing is you are rebalancing your portfolio in order to make sure that the earlier duration of 6 is being kept in the new case where YTM has increased from 9 to 11. So that is what you have to do. Every time YTM changes in this 6 years period, you will have to make sure that the duration is equal to the target horizon. Obviously, this change in the YTM happened at 0th point, both the changes. But sometimes it may happen that after 2 years, the YTM has changed to 13%. At that time the duration required will be 4 years only, because only 4 years are left for the your target horizon. 4 years are left for your liability or whatever cash outflow. So at that time you will set the duration to 4 and then calculate the weights. If it is proper, then it's all fine. Otherwise you will have to shuffle some of the investment from B to C or C to B, etc. Make sure that understand that they have made a constraint here. 45% will be there in A for sure. Whatever you have to do, you can do it in B and C. This is the bond immunization question. Okay, sir, question number 91. Again, have a look on this question. This is the last question on the bond immunization. Little more attention you will have to pay on such concepts. Have a look. Mr. XYZ is required to make a $5 million payment in 1 year and $4 million payment in 3 years. These are the liabilities of this person. After 1 year, he will have to make a payment of 5 million and 3 year 4 million. So when you will start from this point, you will be paying 5 million here, and then 1, 2 and 3. You will be paying 4 million here, right? In 1 year and 3 years time. The yield curve is flat at 10% APR with semi-annual compounding. Firm with semi-annual compounding. Write down this thing. Semi-annual compounding. Firm XYZ wants to form a portfolio using 1 year and 4 year US trips. Understand the difference. You have a liability in 1 year and 3 year, but the bonds available to invest is 1 year and 4 year to fund the payments. You want to invest today so that when the amount is required, you can take it out of this portfolio to make the payment in 1 year and 3 year. So understand, 5 million and 4 years is not today's value. 5 million and 4 million is future value for which you will have to calculate the present value. The present value can be calculated with this 10% rate. But please understand, this is annual percentage rate. But this semi-annual, compounding is being given semi-annual. So for 1 year, it will be 2 periods, and for 3 year, it will be 6 periods. So see, for 1 year, it is 2 period. You can clearly see here, and for 3 years, it is 6 period. So what is being done here is they have calculated the present value of your future liability with 5% semi-annual compounding, and it comes to 4.535 at the beginning for the first installment or for the first payment, and 2.985 for the second payment. So this much of the amount can be called as present value of liabilities. Can I say 5 and 4 millions are liabilities? Yes, sir. So can I say that these are the present value of liabilities? Right. So 4.535 plus 2.985. I can do the addition of both because both of them are at same time. So 7.52 is my present value of liability. That means I will have to create the asset whose present value is also 7.52. The total investment will be 7.52 million today, so that it becomes the required amount that we need tomorrow. Okay, let's go ahead. Firm XYZ wants to form a portfolio with 1 year and 4 year US trips. Now this 7.52 will be invested in 2 bonds having a maturity of 1 year and 4 year. Okay. How much of each strip must the portfolio contain for it to still be able to fund the payment? After a shift in the yield curve. If yield curve changes from 10% to any percent, how much of it should be purchased, 1 year bond and 4 year bond, so that the bond is immunized? First of all, you will need to know the duration. Your target horizon is 1 year also and 3 year also in this question. In the previous question, it was only one horizon, that is 6 years. And the previous question of that also, there was only one horizon, 2 years. But in this question, there are 2 different horizons where you will be needing the money. So at that time, first you will have to calculate the investor's average horizon. Average horizon, average investor's horizon. And it is not like 1 plus 3 divided by 4. No, it's not a simple average. It should be weighted average, because the amount of money that you are investing is very big in 1 year time and very small in 3 years time, right? So what you have to do is you have to calculate the weighted average. Weights will be the amount of investment that you are putting for every liability. So this 1 year liability has a higher amount of investment and 3 year liability has a lower amount of investment. So what you are going to do, this 1 year and 3 year will be kept here. You will multiply this 1 year and 3 year with the weights of each liability. Weights 4.535 in total, 2.985 in total. This is called as weighted average duration. This is your horizon. So on an average, depending upon the amount of liability, we have calculated our horizon, which comes to 1.7939 years. That means on an average, we can say we need both the money in 1.7939 years. That is what we can do now. Once we have calculated the investor's horizon, this should be equal to the duration of the portfolio. Do you agree with that? This should be equal to the duration of the portfolio. Now the duration of the portfolio should be nothing but the weighted average of this. The investment that you are going to make is in 1 year and 4 year strips. You take W for the first year strip and 1 minus W for the second year strip. So W into duration, 1 minus W into duration should be equal to 1.7939 years. Getting it? So have a look on the entire chronology. This is question number 91. First, we knew that we had a liability. Then we calculated the present value of those liability. Then we found that this is going to be then we totaled that liability, and that became our present value of asset. That means we are going to invest this much of the amount. Okay. The next thing that we did is we found we calculated how much should be invested in each. We want to calculate, in fact, how much should be invested in each of the bond. But before that, we will have to calculate the investor's horizon, because let's say, for example, investor's horizon will come from this point. Investors, we can say average excuse me, horizon. Okay, that will become, that average horizon should become portfolio duration. Okay, that portfolio duration, from that portfolio duration we can calculate the weights of investment, and that weight will be applied to this amount, so that we can distribute in 1 year strip and 4 year strip. That weights of investment and the portfolio duration will be like this. Portfolio duration is equal to summation of weight IDI. I can say weight of 1 year bond and duration of 1 year bond plus weight of 4 year bond and duration of 4 year bond, and the portfolio duration will be equal to the investor's average horizon, which is 1.7939. Now understand one thing, maturity of the bond is not the duration of the bond in a normal case, but in this question there is nothing else given for our information, so that we can calculate the duration of the bond. So what we are going to do, we are going to assume that whatever we are going to invest, it will be redeemed directly at the end of 1 year and 4 year. Okay, so that means the cash flows will happen at the end of 1 year and 4 year from the company redemption. We can sell the bond at any point of time in the market, but the cash flows from the company will be at the end of 1 year and 4 years. So that means the duration will also be 1 year and 4 year. So in this question, maturity of the bond will be taken as duration of the bond. So 1.7939 weight 1 into 1 year bond, with the duration of the 1 year bond is 1, and 1 minus weight 1. Weight of the 4 year bond is nothing but 1 minus weight 1 into 4, the duration of 4 year bond. With the help of this, we will be able to calculate weight 1. So how much to be invested in each bond? $1.7939 is equal to weight 1 plus 4 minus 4 weight 1. Getting it? So I can say 1.7939 minus 4, that's minus 2.2061 is equal to minus 3 into weight 1. So weight 1 is equal to 2.2061 divided by 3. That's 73.54% should be invested in 1 year bond, and weight of the 4 year bond is nothing but 26.46% should be invested in 4 year bond. Okay, now understand the liability was after 1 year and 3 year, right? It was 5 million and 4 million. Then we calculated the present value of those liability, that came to 7.52 million. Okay, acha, investors time horizon was calculated with the help of this present value. We took the average. Okay, 7.52. This 7 point, or instead of 7.52 writing it there, I will just write it down in the total. The present value was 4.535 and 2.985. The total of that was 7.52, which becomes the present value of asset. Okay, when we calculated the investors horizon, we took 4.535 and 2.985 as the weights for 1 year and 1 year and 3 year. I think 3 year, yeah, 3 year. So we did the average of that and we found the investors time horizon to be 1.7939. It became 1.7939, which became the portfolio duration 1.7939, because for the bond immunization we say that the time horizon, investors horizon, should be equal to portfolio duration. With the help of this, we calculated the weights. Weights was 73.54%. Let me check the answer. 73.54% and 26.46%. So the weight came up to 73.54 and 26.46% of what? 7.52. So ultimately you are going to suggest $7.52 million into this much percentage, and then this much percentage should be invested in 1 year bond and 4 year bond, and this way we will be able to create a portfolio with an average duration of 1.7939 year, which is the average duration of investor's time horizon, which will help the investor to get ultimately $5 million at the end of 1 year and $4 million at the end of 3 years. How? You have to sell the bonds in the market. At the end of 1 year, you will be selling entirely the first year bond, or you can say mix of both the bonds, some bonds from the 3 year, 4 year maturity as well. So there will be a mix of the bonds that you will be selling in the market, that will bring the total to $5 million so that you can pay off the liability. And the balance will become $4 million at the end of third year, and then you can sell it in the market. Assuming that we can reinvest in the 1 year bond again after its expiry for another 1 year and then another 1 year. So this is a normal assumption. Getting 7.52 into this much percentage and this much percentage, and we have the immunized portfolio. With this, we finish our calculation or the topic of bond immunization. Let's just go through the charts once again. In the chart, you can clearly see the next topic, the 8 number topic, was immunization. A portfolio is immunized when its duration equals the investor's time horizon. Keeping the portfolio's rate of return same, it will give you the same return. Rebalancing the portfolio's average duration every time interest rate changes. This is what you have to maintain. If you want the portfolio to be immunized all the time, whenever the interest rate is changing, you will have to rebalance the portfolio's average duration to make it to equal to investor's time horizon. All in all, you have to remember three things. Investor's time horizon should be equal to the duration of the portfolio. Present value of asset should be equal to present value of liability, and the portfolio duration is nothing but the weighted average of all. Forward rates has been taken care by us in couple of questions, and more of it will be there in the interest rate risk management chapter. So you might see such kind of formulas in the IRRM chapter. So then, sir, why it is given in the security valuation chart? Because it is there in your syllabus in this chapter. So that's why I have written it here. But it will be discussed in IRRM chapter. Even this one also. Okay. And then comes the last topic, which is convertible bond, which is what we are going to discuss now. So we will just focus on the concepts, lots of concepts first, and the understanding first, and then we will slowly shift to the questions. Okay, so let's just take a break of another 5 minutes, and then I will be back discussing the questions, discussing the concepts of convertible bond. See you. So welcome back everyone. After the break, this is going to be the last point for the bond valuation, where we will be discussing some concepts. Convertible bond is the major topic now that we are going to discuss. Under this convertible bond, there are 11 to 12, I think 10 subtopics that we need to know. But first, we should understand the logic of convertible bonds. What are these convertible bonds? It's very simple and easy to understand. Have a look. Let me first write down the topic name. Convertible bonds. Let me tell you one thing. We discussed about lots of bonds in the previous question, and basically all the bonds has these kinds of structure, these common things in them. All the bonds had a face value, let's say 1000 rupees. All the bonds most of the bonds had a coupon rate of, let's say, 10%. They had a timeline of, let's say, 5 years. Okay. And they had a market price today, let's say, of 900 rupees. We used to calculate the YTM of those bonds also. Okay. So these were the structure of the bond. Now what happens is the same bonds with these features can be issued in two different forms. One, it can be called as convertible. It can be called as non-convertible. So till this point, whatever bonds we have discussed in the previous question, we assumed it to be non-convertible. But now if the bond is convertible, if the company is saying that you can purchase these bonds and you will get a coupon amount of 100 rupees every year for 5 years, 4 and 5, what you can do is at the end of, or maybe at the maturity, or maybe at any point in between before the maturity, company may give right to the bond holders that they, if they want, let's say for example at the end of 3 years, if the bondholder wants, they can convert every bond in certain number of equity shares. So that certain number of equity share is called as the conversion ratio. Let's say for example the conversion ratio in this question is 20. What does that mean is, you may purchase the bond today. You will have to pay 900 rupees. You will be getting 100 rupees as a coupon amount every year. So let's say you are paying 900, you are getting 100, 100 and 100 here. Now at the end of the 3 years, you have the option to convert your bonds into equity shares of the companies. If you do so, every bond that you convert, let's say for example 10 bonds you have purchased at this date, and out of that 4 bonds you are ready to convert. You are ready to convert 4 bonds out of that. So what will happen? For those 4 bonds, you will get 20 into 4 equity shares. 20 into 4. 4 are the number of bonds. For every bond there were 20 equity shares. So in total you will be getting 180 equity shares, and you will lose the title of bondholder for those number of the bonds, because now these 4 bonds does not exist. These bonds have been converted into equity share. So practically speaking, company has taken back their 4 bonds and given you new shares in replacement of those bonds. So basically we are replacing the 4 bonds with the equity share. So what will happen in this period? We will be called as the bondholder for those bonds, and the moment we convert them into equity share, we will be called as the equity shareholder, because now we are not the owner of the bond, now we are the owner of the equity shares. Okay, when we were the bondholders, we were getting interest, or we can say coupon, as an income source, annual income source or regular income source. We were getting interest as interest. Okay, and after the conversion into equity share, the regular income source will be equity dividend if it is declared by the company in the normal course of business. Getting it? So this is the simple meaning of the conversion of bonds into equity share. Now that is also dependent on the bondholder. If the bondholder does not want to convert into equity share, he can continue with the existing bond till the maturity, and he will continue to be called as the bondholders, and he will continue to receive the interest amounts. And at the end of 5 years, means the maturity, he will get the redemption amount, and the story will be over. What happens when you are the bondholder? When you are the bondholder, there is some kind of a maturity where the relation between you and the company will end. But once you become the equity shareholder of the company, equity shares are never redeemed. These will continue for on and on and on. And then once you become an equity share, you cannot force the company to take back the equity share and give you the redemption price. No. Now because you are the owner of the company, it will be over for you when the company gets over or shut down. So that's the major thing that will happen by converting from bondholder to equity shareholder. So you need to decide if it is profitable for you, go and get converted into the equity shareholder, and if it is not, then continue with the bondholder. Okay. So one of the concept out of 10 you have learned is the conversion ratio. Conversion ratio says that these are the number of shares that you will receive by converting one bond into equity shares. Okay. Now what will happen? There will be certain kind of a market price going on in the market for equity shares. So let's say equity share market price is somewhat 50. At that date, the date of conversion, you are getting 20 equity shares. On this date of conversion, you will be getting 20 equity shares for one bond. Okay. Now you can easily understand what happened. Let's take that you have purchased one bond at this date. So the payment that you made, the investment that you made was 900 rupees. Okay. You received 100 each year, and now today you can convert that one bond into 20 equity share. The moment you convert that into 20 equity share, your value, your portfolio or investment value will become 50 into 20, because every share is worth 50 in the market today. So 50 into 20 means 1000 rupees will be the value of that equity, of those equity share, which was only 900 rupees when you purchased. So automatically this becomes the capital appreciation to you. One thing, even if you don't convert and keep it for another 2 years, you will only receive 1000. So if you can receive 1000 rupees today itself, I think it's a better opportunity. If you believe in the company and the market price can grow, if you believe that the market price will grow, let's say for example you convert the bond into equity shareholder at the end of third year, and that market price of the equity share grows to around 70 rupees. So what will happen at the end of 5 years? 70 into 20, that means your portfolio value or your investment value will become 1400 rupees, right? Whereas if you were a bond holder at till this point, you would have received only the redemption amount, which was 1000 rupees. So it's better that you converted 2 years back. But sometimes it may go wrong. The market price can fall. It can fall to, let's say, 40 rupees at this date. So 40 into 20, it will become 800 only, whereas you would have received 1000 rupees at the time of redemption. So it all depends upon market. Equity share is risky. The nature of equity share is risky. Things are uncertain in equity share, whereas in bond, things are guaranteed that you will receive 1000 at the end and you will receive 100 rupees every year. So depending on the difference between the equity price and the bond, you will have to decide whether we should convert or not. Let's take one more example. Let's say for example you believe that at the time of maturity the market price will, let's say for example the bond conversion date is the 5 years, means you will be able to convert the bond into equity shareholder at the end of 5 years. In place of 3 years, we are keeping that deadline to 5 years. So at the end of 5 years, you take your money as a redemption or you get converted into the equity share. So if the market price of the equity share on that date, you are assuming it, today you are standing at this point, okay? Today you are standing at this point, okay? One thing is guaranteed at the end of 5 years, that you can redeem the bond and get 1000 rupees. Okay. Now, couple of more things. You are expecting that the market price at the end of 5 year may go to 52 rupees. Let's say for example 52 rupees. So if you convert the equity share, you will get 1040 on that date. 1040 on that date. Now you tell me one thing. By standing at this point of time, will you go with redemption of the bond or will you go with conversion of the bond? There are two options at this point, redemption or conversion. I will still go with the redemption. Why? I will tell you one thing. Because conversion of the bond means getting 1040. Although 1040 is higher than 1000. Okay, it's better. I think we note down. So we have two options at this point, redemption and conversion, and that is just an estimation. Okay, if we go with the redemption, we will get 1000 rupees. If we go with the conversion, we will get 52 into 20 equity shares, that is 1040. I think 20 into 2, right? So looking at the cash flows, anyone would say that 1040 is higher than 1000. Let's go with the 1040 thing. But I would suggest you to go with this only, 1000. Why? Because 1000 is guaranteed today and 52 is just estimated. It may or may not be true at the end of the 5 years. So this is also may or may not be true at the end of 5 years. So why to go with such a why to take such of the risk or so much of the risk only for the sake of 40 rupees of the profit? Getting it? Okay, nevertheless, we'll discuss all these points later on also. Did you understand the basics of the convertible bond? Convertible bond is like conversion of the bonds into equity share. The very first concept that you learned is the conversion ratio. Okay, now one more thing that you can learn here is, if the price of the bond on the date of the conversion, if the price of the if the market price of the equity share, let's have a look on this. If the market price of the equity share on the conversion is 50, so you can calculate, this was the first thing, this is the second thing, you can calculate conversion value, market price of equity share into conversion ratio, 50 into 20. So that's 1000. The moment you will convert the bond into equity share, the entire value of the equity share is called as the conversion value. Understood? Conversion value means the amount of equity shares that you will be getting after the conversion. Okay, great. Now, let's say market price of the bond today is 900 rupees. Okay. Let's say market price of equity today is 40 rupees. Let's say the conversion ratio, because the bond, the convertible option has to be included today, the company will have to specifically express that or say it that how many equity shares, how many equity shares that a bond holder will receive. So conversion ratio, let's say they are saying 20, and let's say for example they are saying that the conversion can be done at the end of the 5 years. All the things are mentioned here. The market price of the equity, this is today's market price, 40 is the today's market price. So 1 2 3 4 5, at the end of 5 years you can get yourself converted into 20 equity shares. So let's change couple of things in this example. Let's say that this bond was issued in the market couple of years back, and all the people might have bought that bond, and that bond is traded today in the market at 900. You can buy the bond at 900. You can buy the bond at 900, and you know that the bond is a convertible bond. That means after a certain period you can convert that bond into equity share. So today you have to make a decision. Since the equivalent equity share is costing you lesser than bond, is it really good to pay higher amount for the bond? Let me explain this. This is a bond and this is equity. One bond is equivalent to 20 equity share in this question. If you say I want to purchase the bond, you will have to pay 900 rupees. But I am saying that if your purpose ultimately is to buy equity share after certain period, let's say after 5 years, that equity share can be purchased today itself at 40. Today itself at 40. So if you buy the equity share today, it will cost you only 800 rupees. So instead of choosing equity share, if you choose to purchase the convertible bond, that means you will be paying 100 rupees more. 100 rupees more. 100 rupees more. This 100 rupees extra is called as the conversion premium. Understand how the conversion premium is calculated. It is nothing but market price of the bond. 900 is the market price of the bond, and 800 is nothing but conversion value. Conversion value was calculated with a formula of conversion ratio into market price of equity. So that is conversion value. Market or price of the bond minus conversion value is equal to conversion premium. We can calculate the conversion premium ratio as well. So this was the third thing in that 10 subparts. The first one was conversion ratio. The second one is the conversion value. The third is conversion premium. And the fourth concept under that is conversion premium ratio. How to calculate the ratio, sir? It's very easy. 100 rupees divided by 800, that's 12.5%. We paid 100 rupees over and above 800 to buy the convertible bond. That's what the meaning is. The meaning of this is we paid 100 rupees over and above 800 to buy the convertible bond. The formula can be market price of the bond minus conversion value divided by conversion value. This conversion value in the denominator can be distributed to both the parts, and I can write it like this: market price of the bond divided by conversion value minus conversion value divided by conversion value. Okay, this conversion value divided by conversion value will become 1, and the ultimate formula that you need to follow will be this. In some places you will find a different formula. They can also, or I will write down, They will say that market price of the bond minus conversion value divided by market price of the bond is also a formula, but I am not happy with that. In one of the question you will find both the formulas have been used, but in most of the question this formula have been used. So ultimately which one will you go with? This one. Okay. So 12.50 was the fourth thing, conversion premium ratio. Now we have discussed till now 4 different sub concepts. The first one was, let me just start writing. The first one was conversion ratio, which means how many shares we will receive after the conversion of one bond. Second is conversion value, which was nothing but market price of the equity share multiplied by conversion ratio as in one above. It shows that after the conversion, what will be the value of your total equity share as compared to one bond. Third, conversion premium. Market price of the bond minus conversion value. It shows that how much extra you are paying over and above the equivalent equity shares to buy the bond. You are still choosing to buy the bond, that's why you are paying this much extra. That is called conversion premium. Fourth, conversion premium ratio. It is nothing but market price of the bond divided by conversion value minus 1. You will get the ratio. Okay. Then comes the fifth point. Till now we have, the fifth point is nothing but the straight value of the bond. Or we can say NCD, non-convertible bond or non-convertible debenture. If you remember, one of the question was on this non-convertible debentures. It means what? It means the bond does not have an option for the bondholder to get the bonds converted into equity share. It's a normal bond with no option to convert it into equity share. At that time, what will happen? Straight value of the bond is the market price of the bond that we were calculating in all the previous questions. Market price is equal to interest in bracket present value annuity factor plus redemption value into present value factor. Now let me tell you one thing. When you buy a non-convertible bond, it's very straightforward that you will be receiving 100 rupees each year and redemption value at the end of the 5 years. So that's why we call it as the present value of all the future cash flow is the straight value. No mix up, no new concept, nothing new. It's straightforward value of the bond. So if you bring out the conversion option from the bond will only be paying interest in the meanwhile period and redemption value at the end of 5 years. So present value of all those will be calculated, will be called as the straight value of the bond. Understood? Straight value is nothing but the market's normal bond price, interest into present value annuity factor plus redemption value into present value factor. Okay. Then the sixth point, minimum price of convertible bond. Let's say in this example, we write down some straight values of the bond. Let me write down straight value of the bond. First of all, what I am suggesting is this bond and this bond is similar in every nature. 5 years to maturity, 10% coupon rate, everything is same. Everything is same but one. What is that? This bond can be converted at the end of 5 years into equity share and this bond cannot be converted. Now tell me one thing. Do you think the market price of the bond, the convertible bond, this is the convertible bond, 900 rupees. And what do you think about the straight value of the bond? Do you think the straight value of the bond will be lower or higher than 900? If you look at both the bonds, you can clearly say that this bond has an extra feature added in the uh, prospectus or whatever the document. This bond doesn't have that feature, so obviously for extra features there will be some kind of premium the company will collect. So this price will always be higher than straight value of the bond with all the other things remaining same. Both the bonds have same maturity, same coupon rate, same face value, same everything. But this bond doesn't have the option. This bond has the option, and that's why this bond will carry a higher price. So let's write down. So, and straight value of the bond, let's say for example, straight value of the bond is 750 rupees. It means that if you do not buy this bond and instead buy this bond, that means you are paying 150 rupees extra. 150 rupees extra for that conversion option. And that is called as downside risk. This is the term that is what they have used, or we can say that the amount that we are paying extra over and above the non-convertible bond. This is also called as non-convertible bond. Non-convertible bonds market price is called as the straight value. So instead of paying this bond, if you are buying the convertible bond, then you are paying 150 rupees extra. That is called as the downside risk. Okay. This is going to be 7th concept. Percentage of downside risk. I will explain the minimum price, and it is nothing but, have a look. Downside risk means how much extra you are paying over and above straight value of the bond. So market price of the bond minus straight value of the bond. 900 minus 750, that comes to 150. We can calculate the percentage also. If you want to calculate the percentage of downside risk, we will say market price of the bond minus straight value of the bond divided by straight value of the bond. The base will be straight value of the bond only, not the market price of the bond. And this formula can again be converted into this straight value of the bond minus 1, because if you put straight value of the bond divided by straight value of the bond, it will become 1. So market price divided by straight value divided by straight value, that is minus 1, and you can calculate it. 900 divided by 750 minus 1, how much extra that you are paying? 20%. 20% of 750 you are paying extra to buy just one feature, conversion option. Otherwise both the bonds had everything same in their category. Okay, now percentage of downside risk is nothing but market price of the bond divided by straight value of the bond minus 1. Am I right? Now coming over to the question. Market price of equity multiplied by conversion ratio. Market price of equity multiplied by conversion ratio will give you conversion value. Now there are three values with you, 900, 800 and 750. You need to tell me if this bond's price is going to fall. If the bond's price is going to fall, how much low can it go? How much below, or we can say how much down it can go? It's very simple, sir. The concept says that minimum price of the bond has to be minimum price of the convertible bond. Let me write down here. The minimum price of this convertible bond has to be higher of the conversion value or straight value. Higher of the conversion value or straight value. First of all, why higher of the straight value? At least it will be higher than the straight value. Why? Because if it falls, if it goes down, 900 price, this price of the convertible bond goes down, it cannot go beyond this value 750. Why? Because it has some extra features. It has some extra feature. Do you agree with this? Let me just take this. This is a convertible bond and this is non-convertible bond. Okay, everything is same in these two bonds, and this is selling at 600 and this is selling at 700. Now tell me, who is going to buy the non-convertible bond? Who is going to buy the non-convertible bond? No one, because convertible bond is better option. First of all, because it has a feature of conversion, and that is available at a lower price. So every investor in the market will go with the convertible bond, and no one will buy this. Automatically the demand of this bond will rise and it will go beyond 700. Let's say now 700 and 700, still everyone would go and buy the convertible bond. Everyone would go and buy the convertible bond. Now 720 and 700, and now the difference will start coming. Some of the investor may not think that 20 rupees extra, may not think it fit to pay for the conversion option 20 rupees higher. So that's why they may not buy the bond, but still maximum people will buy the bond because 20 rupees is much lower price for the conversion option. So again the bond price, because maximum people are buying the convertible bond only, so more than 50% of the demand is in this side. Again this will go up 750, again this will go up 750 and 700. Now you will see that most of the people, many of the people, we can say many of them will think 50 is not extra, paying 50 rupees extra for the conversion option is not worth, and some will buy non-convertible bond, some will buy convertible bond. Those who think it fit, they will buy the convertible bond. Now the demand and supply, demand for both the bonds will start coming to the parity, coming to the same level, and it will come till the point it will the demand stabilizes. What all I want to say is, at any point of time, market price of the bond cannot go beyond the straight value of the bond. So 900 rupees cannot fall below 750 because it has an extra feature. So it will always be more than 750. One thing, again, this market price of the bond, this bond, whosoever is going to purchase the bond, okay, can convert into equity share, can convert that bond into equity share. Let's say, for example, the convertible bond is this and the conversion value is this. Let's take an example. 800 rupees is the conversion value. 800 rupees is the conversion value, and let's say you are getting the convertible bond at 700 rupees only. No one will buy the equity share of that company whose convertible bond is there in the market, because people would prefer first to buy the convertible bond and then get it converted into equity share, automatically claiming 100 rupees of the difference gain, automatically 100 rupees of the gain. See, you and me, if we want to buy the equity share of this company, it's better not to buy the equity share. It's better buy the convertible bond and then get it converted into equity share. So automatically you will get 100 rupees of the benefit. Getting it? So what will happen? The demand for the convertible bond will go up and up and up again. Okay. So it will go beyond 800. At 800 also, everyone would go with convertible bond because anyhow you can get it converted into equity share, but till that time you can have the preference of fixed interest and fixed redemption. So you can enjoy the benefits of both bond and equity share in the same price. If you go with 800 rupees of the equity share, you can only have the equity share. But in this case, with the same amount, you can enjoy the benefits of both. So that's why this convertible bond has to be higher than the conversion value. Now some people will buy equity share and some who think fit will pay extra to buy the convertible bond. So that's why I'm saying market price of the bond will always be higher of the two. If it cannot go below CV conversion value, and if it also cannot go below straight value, that means automatically higher of the two will be the market price of the bond, the minimum. If it has to fall, the minimum it will go is higher of the two. Okay, let's go ahead. Minimum price of the convertible bond will be higher of the conversion value or the straight value. higher of the conversion value or straight value of the bond. Then comes the eighth topic called as conversion parity price of equity. Automatically it means equity. Now what does that mean? It means that what should be the price of the equity share so that buying the bond and buying equity share, buying the bond and buying equity share will be one and the same thing. See, we are talking about this 40 conversion parity price of equity share. Conversion should be at parity. Right now, if you buy the bond of 900 and convert it into equity share, there is a difference in the value. What we want to say is, if after the conversion there should not be any difference. That means this should also become 900. And in order to this value become 900, we have to change the market price. We cannot change the ratio which has already been fixed. What changes on a time to time basis is market price of the equity share. So what should be the price of the equity share where the conversion value will be equal to the market price of the bond? It is 45. If you multiply 45 by 20, it will become 900, which will be equal to market price of the bond. So what is the formula? It's very simple, sir. Market price of equity, which we will call it a conversion parity price, into conversion ratio should be equal to conversion market price of bond. Am I right? So conversion parity price into 20 should be equal to 900. So CPP is nothing but 900 divided by 20, which is 45. This will give you the expected price or the to be price of equity share in the market, which will bring conversion at parity, the bond and equity. So what is the conversion parity price of equity share? It is nothing but market price of the bond divided by conversion ratio. That how much the total amount of the bond will be divided into every equity share. That will become the conversion parity price. Ninth and 10th point. Ninth point is favorable income differential. What is favorable income differential? Let me just explain now. Let's take this. Let's take coupon rate as, or market bond will pay interest. The income from the bond will be interest income, and income from the equity share will be dividend income. Okay. Let's assume that 10% is the coupon rate on 1000 rupees of the face value. So our interest is 100 rupees. Our interest is 100 rupees that we will receive every year. So if we buy the bond, we will get 100, 100, 100, 100 and 100, right? But instead of buying the bond, if we would have bought equity share, then every year, assuming every year the dividend is declared, we would have received dividend. Let's say the dividend per share is 4 rupees. So how much dividend you will get every year if you buy the equity instead of bond? 20 equity share you will have to buy if you want to compare it with the bond. So 20 equity share into 4 rupees of the dividend, every year you will get a dividend of 80 rupees. Right? Now tell me one thing. In which source of investment you are getting a favorable income? You are getting a favorable income in bond. You are getting 20 rupees extra every year in bond. That is called as favorable income differential. Favorable income differential. And what was the formula for this? Favorable income differential. Can I say interest minus dividend per share multiplied by current conversion ratio? Interest on every bond minus dividend per share into conversion ratio. 100 minus 4 into 20, right? But if you have to calculate favorable income differential per share, at that time the formula will be interest minus dividend per share into conversion ratio divided by conversion ratio per share. So on every share, by sacrificing every share, how much extra you are earning. You will see that in one of the question. That's why. Otherwise, remember the first formula only. Interest minus equity income equivalent. 10th. And the last, premium payback period. Which premium, sir? Conversion premium. See, I will tell you, there was one benefit that you bought bond, not equity share, which was the favorable income, right? But for that favorable income, you paid extra amount in the bond as compared to equity, that was premium. You paid 100 rupees extra. Can I say that? In the beginning, I paid 100 rupees extra just to have 20 rupees extra income every year. So that's what the question is asking you, that the amount you paid extra is recovered. 100 rupees is recovered every year by 20 rupees. So tell us how many years it will require to pay back all the extra amount by the favorable income. So it's very simple. You paid 100 rupees extra. Let me write down like this. Bond 900 and equity was 800. So you paid 100 rupees extra if you bought the bond, but every year you received 100 in this bond as an interest and 80 in equity. 180, 180, 180, 180. Every year the favorable income was 20. So can I say that the extra amount, the cost that I paid, this was outflow when I bought the bond, and this is extra inflow. So can I say that 100 divided by favorable income differential means 5 years. If I am recovering 20 rupees every year, I can say that the premium is being recovered in 5 years. After that, if the maturity is still there, all the income will be called as an additional income, that favorable income. So the formula will be the premium that you paid in the numerator divided by favorable income differential. Simply conversion premium in the numerator divided by favorable income differential. On every bond, how much extra you paid, and in every year, how much extra you are recovering. That will give you the premium payback period. So these are the 10 concepts that you should remember. With this, we end the conceptual clarity of the convertible bond. Let me just go through the charts once again so that I will revise you everything, and then we should shift to solving the question. The first one was the conversion ratio, where it says that how many number of shares you will get when you will convert the bond into equity. Conversion value is nothing but the market price per share into conversion ratio. Means the moment you will convert from bond to equity, what will be your total value. Then conversion premium is the amount that you are paying extra over and above conversion value. So market price of the bond, MP means the market price of the bond minus conversion value, that 100 rupees. Premium ratio is MP divided by CV, 900 divided by 800 minus 1. That is just the percentage calculation. Straight value of the bond would trade if it were not convertible to stock. It's equivalent to non-convertible bond. It means a simple interest into present value annuity factor plus redemption value into present value factor will give you the straight value of the bond. In fact, lots of questions have already been done for calculating the straight value of the bond. Minimum value of the convertible bond. A convertible bond should be the lowest, trade at higher of, understand, it can go lowest, but it should be higher of the conversion value or straight value, because it cannot go below both. So it will automatically be higher of either of the two. Then downside risk. It is nothing but the premium paid over the straight value of the bond. That's why we keep straight value in the denominator. This is the bond with conversion option. This is the bond without conversion option. So we can say that this is the percentage that we are paying over and above non-convertible debenture just to have that conversion option in the bond. Conversion parity price is the price of the equity share, which will make the conversion at par with the market price of the bond. So the moment you will convert, there will be no difference. 900 rupees on both the sides. So the formula is market price of the bond in the numerator divided by conversion ratio. N means the conversion ratio. Favorable income differential. Interest from the bond minus dividend from equity into current conversion ratio. Dividend per share into conversion ratio. If you want to calculate it per share, then divide it by conversion ratio again. Otherwise, do not. Premium payback period is nothing but the premium that you have paid 100 rupees and favorable income differential that you have calculated here, that was 20 rupees on our example. So these are the 10 things that you had to learn. Now is the time to discuss about some practical questions. Have a look. Subnum Limited had issued convertible debentures with coupon rate of 11%. Each debenture has an option to convert 16 equity shares at any time until the date of maturity. So this is the coupon rate. 16 is, can I say it is the conversion ratio, and we have any time until the date of maturity. Debentures will be redeemed at 100 rupees on maturity of 5 years. Okay. Question 92. Just a second. Have a look. One, two, three, 4, 5. Okay, question 92 it is. Today's market price is not given 11%, 100 rupees is the redemption. So you will get 100 rupees if you want at that time. 11, the interest will be 11, 11, 11, 11 and 11 for 5 years. Okay, you can convert the bond into 16 equity shares. So if you want to convert at any point of time, you can convert at 16 equity shares. Okay. An investor generally requires a rate of return of 8% per annum. This will be your YTM if you want to discount the cash flows. As an advisor, when will you advise the investor to exercise conversion for given market prices of equity share? Let's say, for example, in the meanwhile, 5, 6 and 7.10 was the market price of equity. Market price of equity, let's say any time, time doesn't matter, 5 or yeah, right, it has something to matter for okay, let's say for example market price is 5, 6 or 7.10. okay, as an advisor, when you will advise this investor to get converted into equity share, obviously out of these three I will suggest to convert him into equity share whenever your conversion value becomes higher than the bond's value. When you can get a profit, let's say for example 100 rupees is the value of the bond, and after the conversion if it becomes 105, then it is profitable. Which investor will convert his 100 rupees into 95? No one. So the conversion value should be higher. Let's multiply with 16 and we will get the conversion value. 80, 96, 113.6. Now one more thing we have to do. This is the conversion value. We have to find out the market price of the bond today. And how to do that? 11 into annuity factor plus 100 into present value factor. We will get to know the real value of the bond today, and if the price goes beyond that, if the conversion value goes beyond that, then that price is favorable for us. So let's have a look. At 8%, 11 rupees into 3993 annuity factor, 100 rupees into 0.681 present value factor, it goes to 112.023. So understand, this is 112.023. So the bond that you are carrying today, is 112 rupees 023 paisa. So it is not favorable for you or beneficial for you if you convert the bond when the market price is 5 or 6 rupees. It is better to convert the bond only when the market price is 7.10, because at that time only the conversion value will be higher than the bond's price. That's the simple answer of this question. See, unless the market price is 7.10, conversion should not be exercised. Simple and plain. Let's move on to the another question. Question number 93. Suppose Mr. A is offered a 10%. 10% is the conversion ratio. Bond is convertible. Par value is 1000, which either can be redeemed after 4 years at a premium of 5% or get converted into 25 equity shares, which is currently trading at 33.5. Now have a look. I think I should reduce the grid lines to 3. It's better. It will increase the page size also. (93) 1, 2, 3, 4. I think 4 years is there. Yeah. 10% means you will receive 100, 100, 100, 100. At the end of 4th year, you will have 2 options: conversion or redemption. Conversion or redemption. If you redeem, you will get 1000 rupees. That's for sure. But if you convert, it will be conversion ratio into market price of equity at that time. Okay, the market price of equity of that time is not given to you. What else instead is given is market price of equity today, okay, which is currently trading at 33 rupees 50 paisa. But the question clearly says that it will grow by 5% every year till 4 year and expected to grow by 5% each year. You are required to determine the minimum price Mr. A shall be ready to pay for bond if his expected rate of return is 11%. Minimum price that he will be ready. Now let me first calculate one thing. The bond's price today. The question is asking you how much Mr. A should pay. Mr. A should pay for the bond, market price of the bond today, and it will be calculated as interest into present value annuity factor plus either the redemption value into present value factor or conversion value into present value factor. In case of convertible bond, right now we are not sure what will be the cash flow at the end of 4th year. If we go for the redemption, 1000 rupees can be put here. Or if we go with the conversion value can be replaced here, and that will be the answer. Now the question has become very simple to you now. First of all, put down interest, calculate 11 annuity factor with 11%, then put down the present value factor also with 11%. Now the only thing that will remain is what will be our decision at the end of fourth year, and that price should be kept here. Now let's find out. First of all, we have to find out the conversion value. Let's increase this market price by 5% every year for 4 years. Okay, so we will add the growth. It's very simple. Compound amount is equal to principal in bracket 1 plus r to the power t. So principal today is 33.50, 1.05 to the power 4. The answer will be 40.72. The market price at that point will be 40.72, and we can convert that bond into how many equity shares? 25. So your conversion value will be 25 into 40.72. So that's 1018. Now you have to decide whether you will go with 1018 rupees or 1000 rupees at the end of fourth year. My answer will be 1000 rupees. Why? I will tell you one thing, because 18 rupees is very small difference, and that extra 18 rupees will be achieved only if the estimated growth rate becomes a reality, the chances of which is not 100%. It may be 50-50 that I'm saying 5% will be the growth every year. If in any particular year the growth comes down to 2 or 3%, this price will go down by 1000 rupees, from 1000 rupees, right? So it's not better to go for the conversion. It is very clear now for me that I will go with the redemption, and that's when we will put the redemption value here and calculate the market price of the bond. Is it okay with you? Yes, sir. This is how you have to make the decision in real life also. Although 1018 is higher than 1000 rupees, still I will not go with this, because I will tell you, write down, I will tell you, this is guaranteed cash flow and this is uncertain cash flow. So for that uncertainty, just 18 rupees is not enough to go with this option. It should have been somewhere like 1200, 1300 or 1400. Then we would have thought for this option, right? Have a look. They first calculated the market price of equity share, multiplied it with the conversion ratio of 25, and they found a new market value. That was not needed. See, conversion value was 1017.98. Our answer was 1018. Almost 2 paisa difference only. Okay, I don't think so this was required. This is not required, first of all. Then since above value of the bond is based on the expectation of growth in the market price, which may or may not be as per expectation, in such situation or circumstances, redemption at premium still shall be guaranteed. Okay, one more thing that I am missing out in this question, that's my mistake, extremely sorry. The redemption was at premium, man, 1050, and that was guaranteed. Question itself says that the redemption will be at premium. So now in any case I will not go with the conversion, because first of all redemption amount is higher, second the 1018 is uncertain. Okay, redemption at premium is still guaranteed and bond may be purchased at its floor value computed as below. So the minimum price of the bond today will be 100 into annuity factor, 105 into redemption value, 1002. This will not be right. We are not going with that option. That's why this price will not be there. See, what they have done is we can say that they have increased their calculation unnecessarily. What they did is they took 1018 in this formula and calculated the bond price. When the decision was we are not going to go for the conversion, then there was no need for the calculation. So just avoid this calculation in exam also. Okay, let's move on to the next question. Question number 94. Very simple and easy question. Well, let's do one thing. I think we can put it for homework, because there are more difficult question and everything out of this is covered in the rest of the question. So I'm just putting this for question for homework. Question number 94. Come over to question number 95. XYZ has a current earnings of 3 per share. This is a question of convertible preference shares, not the convertible bonds, but the concepts will be same. Have a look. Earning per share, earnings of rupees 3 per share, EPS. With 5 lakh shares outstanding, the company plans to issue 40,000 7% convertible preference shares. 40,000 is the number, 7% is the coupon rate. Convertible preference shares of 50 rupees, and that too at par. That means the market price will also be 50 rupees. The preference shares are convertible into 2 shares for each preference shares held. After a certain period, you can convert that preference shares into equity, that too 2. The equity share has a current market price of 21 per share. So let's write down few things about the preference shares and the equity shares. In numbers, there are 40,000 preference shares. 7% is the preference dividend, and 50 rupees is the face value as well as the market price. For equity share, there are 5 lakh equity shares, and EPS is 3 and market price is 21. Okay. The question is, what is preference shares conversion value? It is very simple. Conversion ratio means 2 and the market price of equity share, that means 21. So if you convert 1 preference shares, you will have equity worth 42 rupees. Then we will find out conversion premium. The market price of the preference share is 50 and the conversion value is 42. So 8 rupees will be the conversion premium. First 2 questions were a lot easy. Assuming that total earnings remain same, they are not saying EPS, they are saying total earning, which is 3 into number of share, 15 lakhs. Calculate the effect of the issue on the basic EPS before conversion and after conversion. Before conversion and after conversion, you will have to find out the equity EPS, earning per share. So let's have a look. Total earnings, this is 95. 5 lakh into 3, 15 lakhs. I agree. Less, first of all. Now you have issued preference shares in the market. So first thing that you will pay is the preference dividend. Preference dividend will be 7% of 40,000 into 50. 7% into 50 will be 1 preference shares dividend, into 40,000 will be total preference shares dividend. 40,000 50 into 7% goes to 1,40,000. The balance will be 13,60,000. This is earnings for equity. Then number of shares, equity shares, 5 lakh, and this will be your EPS 2.72. This will be your EPS 2.72, and that will be called as before conversion of preference into equity, because once you convert the preference shares, there will not be any preference dividend and the number of equity share will increase automatically. So if you convert, let's say we will write down all the things here before conversion, and I will write down after conversion on this side. Now how it is going to look like? The total earning will remain same. There will be no preference dividend because all the preference shares have now been converted into equity shares. So the earnings available for equity shares will be 15 lakh and the number of equity share will increase. How much? For every preference shares, 2 equity share will be issued. So 40,000 into 2, 80,000 equity share will get increased and added to 5 lakh. So it will become 5 lakh 80,000. 2 point almost 59. This is going to be your EPS after dilution, EPS before dilution. EPS before dilution, EPS after dilution. See, 13 lakh 60,000 divided by 5, 15 lakh 15 lakh divided by 5 lakh 80,000. Now the next part is very easy. You just have to do all this thing once again by changing only first figure, that is the earnings. They are saying that if the profit after taxes increases by 1 million, what will be the basic EPS before conversion and after conversion? That means 1 million means 10 lakh rupees. So you will have to add 10 lakh rupees to this and 10 lakh rupees to this. Rest everything is same. Okay. 25. So you will get the new EPS. Nothing's new. Shall we move ahead? Question number 96 is interesting one. Have a look. We have to calculate a lots of things in that. The following data is related to 8.5% fully convertible debentures issued by JAC Limited at 1000. 1000 is the face value. Market price is 900. Conversion ratio 30. Straight value of the bond is 700. Market price of the equity share on the date of conversion is 25. Conversion ratio into market price of equity will give you conversion value. How much? 30 into 25 will be 750. Am I right? 750. Expected dividend and that too per share. Per share is 1. Total dividend, total equity share will be 30, right? If you convert, you will get 30 equity share. On every equity share, there is 1 rupees of the dividend. So the total dividend will be 30. Right. Understand. And what will be the amount of interest? Sir, 8.5% on 1000 will be 85 rupees of the interest. So you can clearly see that if you are buying the bond, you are getting to 85 rupees interest income. And if you get equity, then 30 rupees only as a dividend. First thing, conversion value of the debenture is nothing but conversion ratio into market price of equity. Conversion ratio 30 share for each bond and 25 rupees market price for equity. 750 will be the answer. Then market conversion price, another name is conversion parity price, means a price of the equity share which is right now 25, such a price of the equity share which will make the conversion value equal to the market price of the bond. So basically we can keep this as X, this is 30 and the market price of the bond should be 900. So 30 into X 900, that means X is 30. So 30 is the market price of the bond. 30 should be the market price of the bond. At that time, the conversion value and the market price of the bond will be same. Right now, what is the thing? Bond is costing us 900 rupees and the equity share is costing us 750 rupees. At which price of the market price, at which price of the equity, both will be same, 30 rupees. If the market price of the equity share is 30, conversion ratio is 30, 30 into 30, 900. So equity will also cost you 900. Bond is also costing you 900. Okay. Conversion premium per share. They are not just asking you conversion premium. They are asking you conversion premium per share. So it's very simple. Understand? Conversion premium is calculated as market price of bond minus conversion value. And if you want to calculate it per share, divide it by conversion ratio. 30. So if we do the calculation, it's 900 minus 750 divided by 30. So 150 divided by 30, 5 rupees is the extra premium that you are paying on every share if you buy the bond. Ratio of conversion premium, market price of the bond divided by conversion value. Conversion premium is calculated on conversion value. So you need to understand one thing, that denominator will consist of conversion value. So 900 divided by 750 minus 1. 20% extra you are paying over and above 750. So if you will calculate 20% of this, this will become 150. And 750 and 150 will be 900. So you are paying 20% extra. Conversion premium ratio means 20% extra you are paying on the conversion value. Okay. Premium over straight value of debenture. Very simple. Market price of the bond, convertible bond, minus straight value of the bond. How much is that? It's 900 minus 700. That's 200 rupees is the premium over straight value of the bond. And if you want to calculate it in percentage, it will be 900 divided by 700 minus 1 into 100, right? 900, 700 minus 1 into 100. That's 28.57% you are paying extra. What does that mean? This means that you are paying 28.57% extra amount just to buy that conversion option. Otherwise, both the bonds are same. Straight value means the non-convertible bond and 900 means the convertible bond. Favorable income differential per share. The interest that you are receiving in the bond minus equity dividend. Interest is 85 and the dividend is 30 rupees. See, 30 rupees for 30 shares. Equivalent shares are 30. 1 rupees on every share as a dividend means 30 rupees dividend you would have received if you have bought equity share. But instead you have purchased bond. Obviously you have paid 150 rupees extra. You have paid 150 rupees extra to buy the bond, but you are also getting 50 rupees of extra income every year. That's 30. Okay. That becomes 55. 55 is our favorable income differential, but they are saying per share. That means divided by conversion ratio. This 30, understand, this 30 is rupees, 30 into 1, and this 30 is numbers. So once you divide it by number, it's 1.833 rupees per share of extra income. By sacrificing every share, you are earning 1.833 over and above this 1 rupee of the dividend. Instead of 1, you can say I am earning 2.833 per share. Premium payback period. The premium that you paid to buy the bond instead of equity, 150 rupees. And how much time is being taken for this premium to get recovered by the extra earning. The extra cost that you paid is 150 shall be recovered by extra income, which was 55. So 150 divided by 55. Please understand, 150 is nothing but market price of the bond minus conversion value. Conversion premium divided by favorable income differential. So that goes to 150 by 55, 2.73 years. You can also do it on per share basis because you have calculated the conversion premium on per share as 5 and favorable income differential per share as 1.833. So there is no difference in taking 150 by 55 or 5 by 1.833. Everything in this has been divided by 30. So the answer will be 2.73 years. It was the easiest one. Everything has a meaning. Okay. Let's move ahead to the next question. Let's check the answer. 750, 35, 20%, 28.6%, 1.833 and 2.73 years. Keep it as homework. 97, 98. Okay. Question number 99. Have a look. GHI Limited is a AAA rated company which has issued fully convertible bonds on the following terms a year ago. It has been already 1 year. The bond has been issued in the market. Okay. So the face value of the bond is 1000. Coupon rate is 8.5%. That means 85 rupees will be the interest. Time to maturity which is remaining. 3 years, remaining next 3 years. Interest will be paid annually at the end of the year, principal repayment at the end of the bond maturity, that means at the end of the 3 years. Even if these two statements would not were not been there in this question, we would still have assumed the same, that interest payment will be done at the end of the year and principal will be repayment at the end of the maturity. Conversion ratio, that means the number of share that you can get converted your bond into, is 25, and the current market price is 45. The moment you will multiply this conversion ratio into market price, you will get conversion value, which is 1125. Market price of the convertible bond is 1175. The difference between 1175 and 1125 will give you conversion premium. 1175 minus 1125, 50 rupees. Okay, then conversion value of the bond, the second answer is 1125. How did we calculate that? 1125, 40 into 25. Now have a look on the straight value of the bond. How do you calculate the straight value of the bond, sir? I told you we have solved many questions where we calculated the straight value of the bond, right? Interest into present value annuity factor plus redemption value into present value factor. So the formula will be like this: interest into present value annuity factor at YTM for n number of years remaining, into redemption value into present value factor YTM for n number of years. So AAA rated company can issue plain vanilla bonds. Plain vanilla bonds means a simple bond without conversion option. That's what we want. That means the straight value of the bond at an interest rate of 9.5%. And lots of students get confused that 9.5%, they assume that the 9.5% is the interest or coupon rate of non-convertible bond, and they think that the 8.5% is the coupon rate of convertible bond. No sir, if you assume this one also as a coupon rate, then there is one figure which is missing to calculate the annuity factor, which is YTM. What will be the YTM rate? 8.5% or 9.5%? This is clearly coupon rate. You cannot consider this one as a YTM, but yes, this is YTM. So don't get confused. Let me clear one thing. Coupon rate will also be same in the convertible and non-convertible bond. The only difference which has to be there in the convertible and non-convertible bond is that the conversion option. Other than that, face value 1000, coupon rate 8.5%, maturity remaining 3 years, and the YTM 9.5%. Everything is same. Getting? So get it? So this is nothing but YTM. Don't get confused with this as coupon rate. So once you say this as coupon rate, you cannot compare that bond with this bond because both the bonds becomes different. Okay. So what you are going to do, you are going to take 85 as the interest amount. You have everything. 85, annuity factor at 9.5%, redemption value 1000. See, 85, this is the factor, present value annuity factor at 9% for 3 years. Do the calculation. 9, no, not 9, 9.5% for 3 years. And this is present value factor at 9.5%. Okay. And that is nothing but the present value of our system. Oh. They should not have done it like this. Why to increase the calculation? This 85 and 1085, they have done it like this in the table. Instead of that, all the 85s can be taken at one place and then 1000 at one place. Present value of that is 974.96. It's very easy to calculate. Conversion value done, conversion premium done. Okay, straight value, conversion value, conversion premium. What is the percentage of downside risk? It's very simple, sir. Market price of the bond, percentage of downside risk. The meaning of it is how much extra you are paying to buy the convertible bond from the non-convertible bond. So the value of the non-convertible bond is 974.96 and the convertible bond is 1175. So 1175 divided by 974.96 minus 1 will be the answer. this one. Go with this, don't go with this. 1175 divided by 974.96 minus 1 is equal to 20.52%. Okay, then they say conversion parity price means the price of the equity share where conversion becomes at par with the bond price. So conversion ratio into market price of equity should be equal to market price of bond. So market price of bond divided by conversion ratio, 1175 divided by 25. So instead of 40, how much? 45 rupees is the current market price. The current market price of 45 has to go till 47 and only then the conversion will be at parity. Enough? Question number 100. Have a look. This is nice question. Something new that we will learn in this. Okay, so have a look on question number 100. It's very easy question. B International Limited, that is BIL, has purchased 5 years. Have a look. 5 years 15.28% convertible debenture. This is going to be your coupon rate. On 1 April 2021, the convertible debentures will mature on 31st March 2026. From 21 April to 26 March, 5 years. 22, 23, 24, 25, 26. Each debentures can be converted into 20 equity shares, that is conversion ratio, face value of ₹1 any time before maturity. But before maturity, debentures will be redeemed at 100 rupees on maturity. That means we will assume that the face value of the bond is also 100 rupees. So the coupon amount every year will be 15.28 into present value annuity factor plus 100 rupees into present value factor will give you the today's market price of the bond. Okay, and the annuity factors are given to you with 10% as here. Okay, the required rate of return of BIL is 10% per annum on 5 years. So 10% we are going to discount it with 10% and we are going to get the today's market price of the bond. So this is the price at which we have purchased the bond. A consultant has projected the following behavior of shares. He is estimating that from 1 April 2021 means today to 31st December 2022, the price will most likely be 4.5 rupees. And if we go on a passive side, it will be 4 rupees, and optimistic side, it will be 5 rupees. So if we are more of an optimistic person, we can assume it as 5 rupees. Most likely chances are 4.5. When the 3 different prices are given, the most important one to consider is the most likely prices. Another term is 1/1/2023, just after this date, December 2022, January 2023 to the 30th June 2025, the price will be 6 rupees 50 paisa most likely, and then it will be 5 rupees most likely. As a matter of policy, we are going to round up the amount. Okay, you are required to calculate the break-even price at which the debentures can be converted. The debentures can be converted at a price when the equity value should be more than the bond's price. Understand the fact. In the previous question, the first question I think that we discussed. Yeah. Consider this question. The bond's price was 900, the conversion value was 750. Unless and until this conversion value reaches to the bond's price, we should not convert the bond into shares. Who will convert 900 rupees into 750? No one. So this 750 has to reach 900 at least. And at that time, there will be no profit, no loss. When the conversion value, understand, when the conversion value is equal to market price of the bond, there is no profit and no loss, and that situation is called as break-even point. So that's what the question is asking us. At what market price of the equity share, the conversion value will be equal to the market price of the bond. So that will be called as the break-even point. So that is called as the break-even price also. Another word for this, please understand, another word for this is conversion parity price. Simple, nothing else. Because that is the price where conversion value is equal to the bond's price and there is no profit or loss. So first of all, you will have to calculate the bond price with this formula. That's what we did in this part. See, 15.28 rupees into annuity factor, 100 rupees into present value factor, the entire thing came up to 120 rupees. So the market price of the bond is 120 rupees. So unless and until our equity value becomes 120, we should not convert. Okay, so the conversion ratio, what is CPP? 120 divided by conversion ratio 20 shares. We are going to get 20 shares, right? So unless and until each share is of at least 6 rupees, we should not convert. Why? Because the moment it reaches 6 rupees, please remove this plus rupee sign. 20 is not rupees, it is numbers. So once the price reaches 6 rupees, number of shares are 20, and the moment we will convert, it will be equal to our value of the bond. So 120 rupees of your bond will get converted into 120 rupees of equity, and at that time we can say this is no profit no loss situation. And if this is no profit no loss situation, the price of equity in this, which is 6 rupees, will be called as the break even price, the price at which no profit no loss will be there. Okay, so the first part is clear. What is the break even price? Conversion parity price. Another thing, please write down in the bracket in the question itself in the compiler, because next time you will be revising, you should know that this question was very easy, but just because they have used a different wording, you got confused. The ideal period in which BIL shall convert and dispose of the shares. See, in which period we should convert? In this period we should convert. Why? I will tell you. Because in this period only the price is reaching to 6 rupees or crossing 6 rupees. That's what the break even price was. And again, that's not just the thing. If you convert, let's say for example, if you convert the bond in this period and sell the bond in this period, still you will be in losses, because now the prices have fallen. It has come down to 5 rupees, and then the total will be 5 into 20, 100 rupees only. So it will be a loss to you. 120 rupees of the bond has been converted into 100 rupees. So that's why the question is saying convert in this period and sell in this period itself when the price is 6.5 or 7 rupees. That's what they are saying. And dispose of the shares. When should they dispose of the share? In this period, 1st January 2023 to 30th June 2025, when the price reaches 6 rupees at least. See, the ideal period in which BIL should convert and dispose of the share will be 1/1/23 to 30 June 25, as during this period the market price of the share is most likely to exceed its break-even price of 6 rupees, 6.5. Getting it? Very easy question. Question number 101. Nothing's new in this question. I'm keeping this for homework. See, you know how to calculate the market price of the bond. You know how to calculate the minimum market price. Understand new wordings. Minimum market price of equity share at which bondholder should exercise the option. This is nothing but conversion parity price. Again, the price where we should exercise the conversion is the CPP. If the CPP, conversion parity price, is the price, if the market price increases beyond CPP, then it's our benefit, but at least CPP should be reached. Duration of the bond, you know how to calculate the duration of the bond. Nothing's new in that. So question number 101, homework. Okay, question number 102 is new. Okay, let's see. Last question in the bond value, in the convertible bond. A hypothetical company ABC Limited issued 10% debentures. 10%, how much? 10% debenture face value of rupees 100 of the duration of 10 years is currently trading at 850 rupees per debenture. So 10% on 1000 coupon amount will be 100 rupees, right? And 850 is the market price of the bond. The bond is convertible into 50 equity shares, that is conversion ratio. 17 rupees is the market price of the share. So conversion value is conversion ratio into market price. 50 into 17. 850. 50 into 17. 850. Please understand. This 17 is nothing but the conversion parity price at this point, because the market price of the bond is also 850 and the conversion value is also 850. If yield on equity comparable yield on equivalent comparable bond return on the similar bond is 11.80. This is YTM. Calculate the spread of the yield of the above bond from this comparable bond. What does that mean? Spread means how much difference is there. How much difference is there from the yield of this bond to the yield of this bond? It's very simple. Calculate the YTM of the bond given in the question. Let's say it comes down to 12%, and then compare it with 11.80, this new yield, and tell us the difference. So the spread will be 0.20. How easy is that? Calculate the YTM of the bond given in the question, compare the answer with the yield of this bond, which is 11.80, and find out the spread. Spread is nothing but the difference. Obviously, in order to calculate the YTM, if they have given you the present value factor, the only method that you should use is IRR method. Take the factors at 11%, calculate the market price, it should come down to 850. Take the price at 13%, calculate the market price, it should come down to 850. Sir, if that's the case, then what is the use of conversion? Convertible bond 50 shares, 17 share, what is the use of that? In this question, the use of that is almost nothing, because it is coming 850 rupees of the conversion value is coming lesser than 1000 rupees of the redemption value. Understand? If this is the conversion or redemption point, if you convert, you will get 850 worth of equity share, and if you redeem, you will get 1000 rupees. So it's better to go with 1000 rupees. That's what is shown in this question. So have a look. Patiently we are going to handle this. Conversion price is 850 value. Intrinsic value is 850. That means this is nothing but CPP. Okay. Next. According to the yield on the bond shall be calculated as follows. The yield, the YTM that we want, should be calculated as follows. The annuity factor should be, and the present value factor should be such that the present value of all the future cash flows should come to 850. So first we took 11% and found that the difference is coming to 91 rupees. That means I can say that 850 plus 91. The answer would have been 941 at this point. Let me check it. 589 plus 352. Yeah, 941. And with this, the answer will be 542.6 plus 295. 837.60. So the difference is 12.40. The difference should have been 0. Okay. Then we applied the interpolation, and then we found that the YTM of this bond is 12.76%. YTM of this bond is 12.76%, and the spread is 12.76 minus 11.80. Calculate the YTM, deduct it from 11.80, and this will be the spread. Spread, in other word, is nothing but the difference. That's it. Now you might ask a question that what is the use of conversion option then? What is the use of conversion option? I will tell you. You look at this thing, 1000. This means that if we are taking 1000 as a redemption value, this means that we are not opting for conversion option. We are going for redemption. And why did that happen? Because conversion value was lesser than the redemption value. Which investor will prefer a lesser amount of shares? Instead, I will redeem the bond at 1000 rupees, keep 150 in my pocket, and if I have to buy, I can buy the equity share directly for 850 rupees. Why I will lose 150 rupees on such a transaction, such a conversion? So investor chose to go with 1000, and that's why we took 1000 in that equation. If in case the question would have been different and the market price would have been, let's say 22 rupees, at that time the conversion value would have been 1100, and we would have chosen convert the bond and sell it immediately in the market. So at that time this value would have been 1100. So yes, there is an importance of that conversion data given in the question, but unfortunately it was lower than redemption, and that's why it got rejected. In the next question, if they ask in the exam, they might ask you in such a manner. So please remember, this should be the conversion value or redemption, or just write down one thing. Simply speaking, mark 1000, and this is nothing but, this should be taken as conversion value or redemption, whichever is higher. So next time you revise this question, you should understand why 1000 was taken. It was not that easy. You should understand. So we are done with all the questions related to the convertible bond, and now we are going to shift in the next lecture with the bond refunding. See, so we started from this part, 92, value of the convertible debenture, then minimum price, convertible bond, convertible, break even price, convertible bond, and spread of the yield. Now the question is 1, 0, 3, 4, 5, 6 related to the bond refunding. These are little big questions, so we are going to solve a couple of questions, and a couple of questions will be given to you for practice. So the next lecture will be based on that only, and after that we are going to start with the money market questions. Okay, bye bye for now.